It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
And it's the Real Estate Breakfast, back again for another weekend of chewing over what is happening in the property market. Hope you've got a fantastic weekend coming up. Be very careful too on those roads if you're travelling around. You can listen to us in the car, of course. It's always a good place to listen. All of the latest property news 7 days a week. And we are streaming right now on iHeartRadio, Spotify, Apple Podcasts and Amazon. Well, it is a Saturday morning, February the 15th. Hope you had a fantastic night last night with Valentine's Day with a loved one. Yes, the restaurants absolutely love this time every year. Now, distressed properties, we should give this a bit of a mention because they have hit their lowest level since the Reserve Bank's rate hikes began in early 2022, signalling resilience among homeowners despite cost of living pressures. January, in fact, marked the first time all capital cities saw a decline in distressed sales thanks to strong market conditions and rising property prices. Now, the ability to sell quickly at solid prices has helped struggling homeowners avoid urgent or forced sales. And with the selling conditions remaining favourable, fewer properties are being listed under distressed conditions, and that has got to be a good thing. If that is in any way sort of relating to you, do let us know. Our email address, as always, is myrealestatePodcast@gmail.com. Now, we're going to catch up with Anthony Landahl in just a moment, and we're going to be talking about, well, there's a lot of media talk, political discussions, or even just the casual chats at the local pub. Everybody is talking about the interest rates and the potential rate cuts in 2025. But what will a rate cut actually mean for you in dollar terms? So breaking it all down on our Saturday morning is our expert Anthony Landahl from Equilibria Finance. Good morning, Anthony. Another weekend has rolled around.
Good morning, Craig. Great to be here, and nice to have hit the weekend again after another really busy week in the property market.
Yeah, and we're going to be having a look at the all-important rate cuts because Australia's cash rate journey from 0.10% back in April, if you can stretch your memory back to April of 2022, and then to 4.35% in November of 2023. It's been a major financial shift for mortgage holders. This rapid rise, Anthony, has significantly impacted borrowing power, repayments, of course, and overall affordability. So we're going to look back at how have existing homeowners and first-time buyers navigated these challenges and what has been the broader effect on the property market.
Yeah, it's interesting to reflect back on it. As you said, back in April 2022, we were 10 basis points and the cash rate up to November 23 went up to 4.35%. That's an increase in 4.25% in interest. Some perspective on existing mortgage holders, someone with a $750,000 loan might have been on a rate of 1.99% back in April 2022. That increase might see them on a rate of 6.24%, which would represent an increase in repayments of $2,000 a month, which is over $20,000 a year. So it's had a significant impact on existing mortgage holders. The average Australian household with a mortgage has been impacted round about $16,000 to $17,000 a month. More broadly, the impact on households obviously is higher loan repayments. For those trying to get into the market, the big impact has been on affordability. The amount they can borrow has been impacted up to maybe $200,000 or $300,000 less than what they could borrow previously. For example, if someone could borrow $1 million back when the rates were in April 2022, their capacity might have gone down to $700,000. So they're having to look at where can I afford to actually buy a property now and what type of property can I afford to buy. So those rate rises have had an impact significantly on existing mortgage holders and those trying to enter the market.
Yeah, when you're sort of breaking it down and somebody's got to find an extra 20K a year, I mean, that is the market that we were in. And we say in because we're hoping that these interest rates are going to start coming backwards. So if we look at the existing mortgage holders at the moment, a potential rate cut in 2025 could provide much needed financial relief. But what does that actually mean in dollar terms? How much could repayments decrease, Anthony, and will it be enough to ease these financial pressures that we're talking about? Or will there be other factors such as inflation and wage growth? Could that possibly dampen the benefits?
For households in the Greater Sydney region, a 25 basis point cut, which is probably going to be one interest rate cut, the average household would save around about $190 per month. For a unit, it might be $100 per month. Now, if we get 4 rate cuts, which would be 1% off current interest rates, assuming they're all passed on, and say we got 4 rate cuts, for someone with a mortgage on a house, that would actually be $770 a month, or close to $10,000 per annum. For someone with a unit who might have a lower mortgage, it represents about $410 a month, or around about $5,000 per annum. So there's some genuine savings in monthly repayments, especially if we see a series of rate cuts. The challenge, of course, is will the rate cuts create an increase in consumer confidence that may flow back through to inflation, which is the real balancing act that the RBA's got. They don't want to cut too early, they don't want to cut too much and spark an increase in inflation, which would be counter to the whole objective of the rate cuts. Unemployment market remains very low, so employment remains strong. So households generally have the income to make their repayments. As you said earlier in the introduction, the actual number of people who are having forced listings is at their lowest amount. Unemployment's low, which is really helping households manage mortgage repayments. So yeah, I think the impact is actually going to flow through. We've got a strong employment market. As long as we stay on top of CPI, those savings are going to make a significant impact for those people who have been struggling to make their repayments.
Yes, this morning people are sort of rubbing their hands together with glee, just licking their lips thinking, wow, what is this going to do? This is going to absolutely get me out of the bind as soon as the interest rate starts to fall. And with housing affordability, let's face it, it's at its worst level in 3 decades. Many hopeful buyers, they are hoping to get into the market. So if the interest rates start to fall, Anthony, how much of an impact do you think that this is going to have on borrowing capacity and accessibility? Because those two key things are going to conflate together for the benefit of mortgage holders and those looking to get into the market. Will it open the door for more buyers, do you think, or will it increase competition? This is the other end of the wedge here and push prices even higher.
My sense is from the market, from the clients we're talking to, is they're similarly sitting around the kitchen table, rubbing their hands, waiting now to see what happens with the interest rates, knowing that it could be an opportunity to get in the market. It'll increase their borrowing capacity. The other thing we're seeing in the market is there's more supply on the market. So there's more opportunities for buyers. So I believe the next 12 months, if we see some interest rate cuts, we're going to see an increase in capacity for those looking to get in the market. We haven't got as much scarcity in supply. So I actually think we're going to see a fairly robust market over the next 12 months where the real heat's taken out, where there was that massive mismatch between supply and demand. We've got more supply, but we've got buyers genuinely coming back in the market in an environment where rates are going down. They're not borrowing to their maximum capacity with rising rates. So yeah, I think those looking to get in the market, some have been holding off, waiting for this opportunity where rates are going to start coming down. So I think it's going to create a lot more activity amongst those buyers.
Yes, as we say, of course, there are a lot of excited people, and I do want to come to just ask you what's happening out of your office, because you would have no doubt had all these conversations, a lot of them with first-time buyers that have been sort of priced out of the market, but they're just waiting for that first rate cut. I mean, how excited are some of your clients over this?
Yeah, really good question, because I don't think I can remember a busier January and February than we've had for a number of years. And that's with new inquiry around people looking to get into the market. It's not just owner-occupiers, it's investors. They're wanting to get an approval in place. And the other thing we're actually finding is people are out there buying. They're putting an offer on the property. They're often securing it at a price point that maybe a year or two ago was unachievable. We've had a softening in the market. There's more supply. So yeah, we are actually seeing a lot more activity around pre-approvals, as well as people with pre-approvals actually securing the property thereafter at the price point that they're looking at, which is fantastic. I think it's also worth touching on, Craig, our existing mortgage holders. Our post-settlement care team is working as hard as they ever have been, looking at potential opportunities for customers to fix their rates. There's a lot of movement around the fixed rates at the moment. There's even a little bit of movement around those variable rates as we work into the year, with some providers starting to give better discounts on the variable rates, and a number of providers are dropping their 2 and 3 year fixed rates in readiness for 2025.
Yes, and people don't have to wait too much longer, of course, because this coming week is going to mark the first announcement coming from the RBA. And Anthony, you're going to be right across that, so we will look forward to catching up with you next week.
It is going to be a very busy Tuesday, I have a feeling, so looking forward to it. Thanks, Craig.
Every morning from 6 a.m, we bring you the latest real estate news with diverse perspectives from leading industry experts. We deliver the most property podcasts across Australia every week.
Look, it's a very common question, and it is a myth. So old properties, new properties, you can claim depreciation deductions. So many of the older properties that we have in Australia now have all been through renovations.
Co-investing, as I said, it's becoming increasingly popular among millennials as they seek to share financial responsibilities with friends or partners. How much of that inquiry at the moment are you seeing?
It's on the rise. It's something historically we haven't seen a great deal of. And from a depreciation perspective, when you do go and buy a property with your friend or with a family member, the depreciation deductions will provide 2 different reports. So one for each of the investors, or if there's more investors that are part of the syndicate that have purchased into that property. So we are seeing an uptake in it and an increase, and with the increase of property prices across the country as well, as a business we're expecting to see increase as well.
It's the Real Estate Podcast, talking properties from 6 a.m. every day, from every corner of the Australian real estate market. We connect you to the best real estate information across Australia. The Real Estate Podcast.